Morning, everyone. Good morning on this Friday, and I trust you're well. And welcome to this live session as we talk about why is my actual investment return lower than fund returns. And we go live on YouTube, Facebook page, as well as LinkedIn. And thank you for joining me live. If you are unable to make the session, just remember that there's a recording on all these platforms after this live session. So today I am very pleased to have a guest to join the studio. Let me bring her in. It's Roné Swanepoel from Morningstar. Roné, how are you?
Good, and you, Kevin. Thank you so much for the opportunity to join you today. It's great being here.
Great. Thank you. Thank you for joining me for this discussion. And I'd just like to give everyone a bit of a background. There's a client investor, Buck. He raised a question about his tax-free savings account in terms of the actual return of 1.42%. But then when he checked the underlying fund returns, checked the fund fact sheets, he found that most of the funds return for the last year was between 6 to 10%. So he got this question saying, why is my actual return below those the underlying fund returns? And I thought it's quite relevant to a lot of investors out there because that especially right now where perhaps because of the last few months with a falling market and a falling fund returns, that more and more investors are looking at the fund statement and looking at the return and found that maybe the return has been below their kind of expectation. And then I think it's important that we have the session to discuss why the actual return is below the fund returns. So I just want to give everyone, all the viewers out there, a bit of a context. So when Buck discussed his tax-free savings account with me, and he's got a recurring investment. So it's a debit order that went off every month, 3,000 Rand a month at the beginning of the month. And for the last 12 or 15 months so far. And last week when he was went onto the platform and looking at the return that he's actually got, and he was a bit disappointed, and he was starting to asking why is the difference? You know, what's the underlying fund? How is it good? Is it adequate? And then he threw me this question, and then so I say to him, I'm going to have someone to join the session and to talk about this. So I just want to highlight a couple of things in terms of this the context. So Buck he drew that report around 4th of May, and then he looked at the past 1 year return, and then he also pulled the fund fact sheets. If I went back to look at those fund fact sheets, because there's a lot of funds in the portfolio, that the fund fact sheets was as of end of March 2022. All right, so let me bring Roné into the discussion here. So what are the reasons that the actual return that the client is experiencing lower than the fund returns?
I think, Kevin, when you think about the fact sheets that he had a look at, one big thing will be time period. So when a client looks at their platform statement, it might be from the, like you mentioned, from the 4th of May to the 4th of May. So he's invested 4 May to 4 May, but he's looking at fact sheets till the end of March. And if you look at
All right.
the market till the
Yeah.
end of March, there's been quite a bit of a movement in market. So it might be different if we look at the first quarter in of this year. The rand strengthened almost by 10%. So it does changes quite quickly. So it's probably going to be one, time period, and then two, fees. So when he looks at a fact sheet of the underlying managers within a portfolio or a managed portfolio, what he's going to see is the returns of that underlying manager after their fees, excluding platform advice or model portfolio fee. So that also comes into play. So I think the two big things is time period and fees.
Right. I forgot to introduce Morningstar. I think that we have worked with Morningstar for a long period of time, and about almost 3 years ago, we started to use Morningstar's managed portfolios for our clients. And I think that Roné, can you just tell us more about Morningstar and the services provided by Morningstar in South Africa?
Yes, so Kevin, Morningstar is actually quite a well-known name. So if you think about Morningstar Inc., it's listed on the NASDAQ, really started as a tech and data business. So
Right.
true tech business. We've got a flagship product, Morningstar Direct, which is providing data to investors about unit trust and their retirement savings. So that really is the birth of Morningstar, was a handbook comparing different unit trusts. And that started about 37 years ago. So Morningstar Inc. About 10 years later, clients came to us to say, you've got all of this data and tech, you've got all of this research. Why don't you just build portfolios, clients? And that was the birth of Morningstar Investment Management about 27 years ago. So we across 27 countries, we manage about $260 billion in assets. If you think about our investment management business, and we in South Africa sit as part of the global team. So when you think about Morningstar and the team at Morningstar Investment Management, although we sit in South Africa, we're part of a team, and that global team's global insights feed into our process. So it really is a global process when you think about working with Morningstar.
Yeah, I think that's what I enjoyed working with Morningstar. I used to use Morningstar for fund rating previously when I was trying to pick the funds for clients to put into portfolio. But I think the challenge, especially for me as advisor, is that there are just so many funds out there, especially global funds. And how do you put it together from the mixed point of view, risk management point of view? And that's why almost 3 years ago, I decided to partner with Morningstar. I think that over the last almost 3 years, it has proven the track record for my clients, and in terms of delivering performance, but also managing the risk. I think that let me just go. I forgot to talk about internal rate of return, because so let me go to that. So with when the investor look at the report or looking at the return, then variably that all the platforms, they will use something called the internal rate of return to calculate the return for the clients. So essentially, internal rate of return is a metric or a way of calculating investment return on an investment. Typically, when a client invests, maybe it's a lump sum, or maybe it's ongoing on a regular basis, then what happens is that from the investor's point of view, you will actually have a negative cash flow, because actually money going out of your pocket because you're investing. All right, but at the end of the investment period that you look at, then you see your current investment or account value, and that's a positive cash flow. So the internal rate of return will take into account all the cash flows at a different point in time, and actually discount at a specific interest rate in order to calculate the rate of return. So that's what it means in terms of internal rate of return. Okay, so I just want to again go into what Roné was saying about the fees. She was talking about the advisor fee, about the platform fee, and also the fund manager fee. So when you, as an investor, generally when you look at the fund fact sheet from a specific fund manager about specific fund, that those returns are already net of the fund management fee of that fund manager. Then on top of that, there's an advisor fee. If you work with a financial advisor, then there's a negotiated financial advice fee that you have with your advisor. Typically, on an ongoing annual basis, it can range anything between 0.5% to 1% in South Africa. And then you may have the platform fee if you are advisor or you use the service of a platform. There are a few platforms prevalent in South Africa. There's 91, Allen Gray, Glacier, All Mutual Wealth, etc. that a discovery that depending on the platform you use, there's a platform fee. And generally, what I've seen in the market is that the platform fee can range from 0.5% and on a tier scale, so go down to 0.1% depending on the amount of assets you have on the platform. So the more assets you have, the money you have on the platform, then the lower the platform fee. So that's how it works. So that can explain part of the reasons that why your actual return is lower than the fund returns. Okay, so let's move on to the next. Is that Roné? Let's talk about the reasons for the current poor return. I think that, you know, I was saying to some clients recently when I had the annual meeting with them, just went through their portfolio, and I point out, I normally show how their investment has progressed over the last since inception or over the last 12 months. And I pointed out to them, if I show them the chart at the end of December last year, it would look wonderful, because I think just about all the investors, they got returns north of 10%. However, 4 or 5 months down the line, now we're in the middle of May, and the picture has changed so significantly from the 10% now it's just down to 1% or even negative. Why is that?
If you look at, so if you think about a tax-free savings portfolio, which is, I think, the one that we're looking at today, is the nature of a tax-free is you want really a long term. So over the short term, there will be volatility, because what you have in that tax-free savings portfolio is a lot of growth assets. And growth assets naturally do come with somewhat of volatility. But it's exactly like you say, Kevin, if you rewind it back to the end of December, returns were wonderful. If you look at the first 3 months of 2022, so quarter end, we saw a very strong rand. So the rand strengthened almost 10% in the first quarter. If you think about our free savings portfolio, it's a predominantly offshore portfolio. So that hurt with the global market volatility that we've seen offshore. That rand strength also hurt your offshore positions. So you had underperformance from that side, and then you don't have a lot of fixed income or a buffer to really bring that stability, because the nature of a tax-free is you want as much growth assets as possible. So it really was a combination of global equity markets that struggled, as well as a strengthening of the rand. But if we look at April, May, it's already changed quite significantly. We've seen a rand weakening, the global positions actually being positive. If you look at them just to, I think, the end of last week and mid this week. So it's a very different picture. The market is moving quite quickly on a month-to-month basis. So the picture changes dramatically every month. But the one thing I would say for any investor in a tax-free savings portfolio, it really is, if you look at that portfolio, it does exceptionally well over the term. We've already have a long-term track record managing the plan. And I think if you look at that long term, that's really where you want to keep your focus.
Yes, that's right. When you talk about it, I think that one point I will make is that after the session, I will also then upload the latest fund performance snapshot under the comment section, so that whoever is interested can just download that and have a look at the return history of the Morningstar managed portfolios. And I think, again, that the important point is not to look at short term, because 6 month or 1 year return can fluctuate quite a lot. But what you want to make sure is that over long term, say 5 years, has the portfolio or the fund delivered for you. I think that I just want to go a bit into the tax-free savings account portfolio that Morningstar has constructed for our clients. And if I look at the asset mix, it's about 70% offshore, 30% local SA. And then in terms of the number of funds, it's about, I think it's about 9 or 10 funds there. So there are some good equity funds like a Fairtree, and then there's also, I think it's PSG equity fund local side. Then there's also offshore funds. There's quite a number of offshore funds. I think there's an element of property fund, etc. So all these funds they can work differently at a different period of time and different market conditions. So like Roné was saying, that because of the positioning of this fund, this portfolio, that it's a kind of quite a high weighting to offshore component. So when the rand was strengthening, then investor will see in the short term that it seems like the portfolio hasn't done much or actually went into negative. But when the rand start to depreciate, like we have seen for the last 3 weeks, I think the 1 week that the rand is depreciated by 10%, then we saw then the portfolio has done quite well from that point of view, from the rand depreciation. So we need to understand that. So I think also it's important when we talk about that kind of a portfolio management or like putting funds together. We also always talk about like diversification. That's why we are not just investing clients' money in just one fund or two funds, but through Morningstar's methodology and the research and the way they manage risks, that they put together a portfolio that's going to perform in different conditions. And that, I think that's important. Okay, so that's let's move on to Roné, what's the current Morningstar position in terms of given the current market? How does it look at the moment?
So if we look at our positioning, maybe I'll split it up into the different asset classes to make it easier. So if you think about SA equity, and if you look into, so how our process works is we look at asset allocation and asset classes. So our capital markets research is first and foremost about asset classes. So what is our conviction in the different asset classes? And then we move on to manager selection. So if you look into our portfolios and you drill down into the portfolios, our convictions will reflect within the positions we hold within the fund managers as well. So SA equity, we've got exposure to broad market beta with a small tilt towards resources and financials, and also consumer defensives. So SA equity, a really good diversified set. If you think about local equity, SA bonds, we remain overweight. So if you look at the yields we can get out of bonds, really good yields. There's this additional yield pickup over cash and an asymmetrical payoff when you think about bonds. So within the portfolios, we've got an overweight to local bonds. And SA property, we feel is still attractive. So when we look at our valuation through our valuation lenses, if it's absolute, relative, contrarian indicators, or fundamental risk, property screens is attractive. But we do still feel that there's fundamental risk in property, and which means you have to size and look at where you fit property in a portfolio very, very selectively. And what we've done is, when you look at the range of Morningstar portfolios, we've only included property in your more high-risk, aggressive portfolios, like a tax-free savings account, where you would see a small property allocation, so not larger than 5%. Just we think there's good opportunity, but you have to be aware of the risks. So you don't want to take too much risk in a portfolio. And then equities, given the nature of that tax-free, we have a lot of global, like you mentioned, a good split of diversified managers. Got the likes of someone like 91 Franchise holding your more defensive stocks. You've got a broad-based passive tracker within the portfolio to bring costs down and give you broad exposure to the markets. We've got some emerging markets in there. We think, although emerging markets have been quite hurt, if clients look into the tax-free savings portfolio, that emerging market position was actually quite negative over the last number of months. There's been this general risk-off environment, getting out of emerging markets being in the first step in this risk-off environment. So we've seen slight detractor there, but a broad diversified exposure on a global scale.
Yeah, I think that's thanks, Roné, for that rundown. I think that's really important. I think the message I picked up there is really about diversifying. I think that I've learned the lesson in the past, and I think that many investors, we continue to learn the lesson of, just have a one-way bet, to think that the rand is going this way, so I'm going to invest this way. But the rand, if anything, we have seen is volatile. It can appreciate like we have seen since the second half of last year until like a month ago. they depreciate. So it's important just to diversify. So you have a different levers to pull. Okay, and I just want to, sorry, I just want to recognize people who joined the chat, and I saw quite a few. First of all, I just want to thank you, Vanna, for being here. Okay, then this next one is Yanka. Thanks for joining, and then thanks, Buck. And then there's Terence. Then the next one we have Melikaya. Okay, thanks very much for joining us this morning. And by the way, if any of you have any questions, please feel free to raise it here so that I can also just then share with you. And then I see there's Tepo. Welcome to our session. All right. So thanks very much, everyone, for being with us. And let's continue with our next question. I think probably is a very important question at the moment for investors out there. And again, I just maybe just bring the slideshow up so that Roné can maybe just go through some of that. I think right now investors when they start to check their maybe investment statement or log into the account to look at how the investment been doing, and then for the last few months they are seeing that it seems like their investment value is being falling. And as I've been watching the market for the last week or so, there's been quite a lot of volatility, and also the U.S. market has fallen sharply. So naturally, as investors, I think there's many investors can be panicking to say, like, am I losing money? What am I going to do now? And so how should the investor respond to the current situation? We have heard in the market commentators, they say, do you sell? Do you buy more because now it's going down? You buy more because you're buying at a lower price. Do you hold, or do you switch the funds? What do you do? All right. So Roné, let's hear what you have for us.
So Kevin, I've actually put together some slides, and I think the graphs will paint a nice picture of, I think the best thing is when your plan and your investment objectives haven't changed, you shouldn't change your portfolio, and you shouldn't focus too much on the short term, because if you look forecasting, it's actually even impossible for professional forecasters to get it right. The three most important, and one of my colleagues actually used this in one of her presentations. She said the three most important words when you think about trying to predict what's going to happen in the short term is I don't know. Those three words are probably your most important. And if you look at, so what I'm showing you on this slide, the range of outcomes over short time periods. So what I took is rolling 1 year returns for SA equities, SA cash, SA bonds, SA property, global equities, and emerging market equity. So what the range of returns mean, it's from your lowest return you could get in a 1 year period to your highest return you could get in emerging markets over a 1 year period. And something to point out, if you look at 1 year periods, look at this range of return in emerging market equities. You could have gotten over 1 year minus 40, or you could get positive 60. So there's 100% variation in returns. If you look at SA property, 88% variation in returns. SA equity, local equities, 86% variation in returns. But look what happens when you take that 1 year return and you say, let's look at this, something similar over 10 years. So this is the exact same picture, but over 10 years. And two big observations here. If you look at the range of returns, it's a lot narrower. So 12% variation in return in emerging market equities. If you think about the previous slide, there was 100%. In SA equities, 86%, now 13%. So the range of returns becomes much lower. And look, every single asset class we show here is in the positive. So over the long term, the market is more predictable. So really having that long-term strategy is very important. If you think about the long term, we always talk about long term, but the long
Yeah.
term doesn't excuse you from short-term market movements. The long run is just
Sure.
a collection of short runs you have to put up with. So there's going to be wars and financial crises and pandemics. It all is included in that long-term return.
Right. Roné, I think those two slides you show, the previous slide and this slide, is really illustrate very well why the investors, if you are investing for long term, you need to look at the long term possible results and what you can deliver over the long term instead of looking at short term, because that your previous slides show that, for example, as a property, and also that in terms of the emerging markets, it's so volatile. And if I look at the global emerging markets since last year to now, it's really atrocious. It was like down 40% or something with Russia, Ukraine war invasion, and then looking at China, the story, and the Chinese stock market is being fallen, and it doesn't seem to be recovering anytime soon. So it's going to be a very volatile, and sometimes investors could get lucky, and they say after they invested, they got 30% return. I, as an advisor, would like to show that picture, and that's quite pleasing. But I think the value for me as an advisor really is to help clients to stay the long run and not to panic, because that when you panic and you just cash out and you actually lock in your loss, so to speak. But whereas if an investor stay the long run and focus on, I like this 10-year picture very much. And if you look at it, especially when the investors got a diversified portfolio of asset equities, cash, bond, property, and offshore, etc., then you can see that generally, if you look at this kind of return profile that is telling us, then the clients can expect after fees, 8%, 9% return. That should be a quite a reasonable result. Yeah.
Absolutely. And if you think, I've actually got one more slide about staying invested, and you touched on wanting to cash out. I thought this is perfect. If you think about cashing out, we all we hate losses more than we love gains. So if you see
Sure,
those losses,
sure.
we really want to get out of the market. Maybe cash. We look at our the cash we have in the bank, and we say, well, that's not moved. So should we rather just get out of our long-term investments and just move them to cash? And what I'm showing you on this slide is, and it comes back to that thing of time in the market, not timing the markets. And what is the cost of market timing? So let's say an investor is from 1995 and he invested to 6 March 2020. And he had an initial investment of 1,000 Rand. If he left that investment through all of the markets, so from 1995, we had the tech bubble burst, we had a global financial crisis, emerging market crisis, we had wars. Everything is within that time period. So everything you could think of, higher inflation, higher interest rates. If we think about just leaving our money, we would have had a 12.1% annual return out of our portfolio.
That's pretty good.
It's a pretty good return. But
Yeah.
if we said anytime we panicked, let's just get out of the market, and we missed the 25 best days in the market, and usually the best days do come after the worst. We just miss that 25 best days. We shave our return in half. So from 12.1% to 6.3%. And as you go along, you can see miss the 100 best days, and you're in a negative return. And if you put that in rand amounts, you would have had 15,000 if you just left your money. You would have had 8,000 if you missed those 25 best days. So it takes a lot of
Sure.
it takes a lot off that return, and you really want to stay invested. Over the long term, the market's done extremely well, even with these short-term market movements.
Well, Roné, I think this chart is really staggering to me. I mean, I think that's especially a lot of investors when they see that returns is not good, or is like a market's crashing, then they just say they want to take the money out, and that could have happened at the the worst time possible, so to speak. And what you said about like best days generally follow the worst day, that I think that's pretty true. I've also observed the market movement for the 20 odd years I've been investing in that. And yeah, you will have sometimes you have a crash, 3 or 5% crash one day, but then invariably the next few days there will be a recovery, and that also quite a sharp recovery. So what you have shown here, like investor, they're trying to time the market and say, okay, let me be smart because I think the market could fall further. Let me take the money out and wait for the market to fall further, and then I can reinvest again. But then that's a kind of a problem and risk you're dealing with. And then I think that the example you show here, you take the 25 base days out of the market, and then that's you almost got half of the return. Compared to 15,600, you only get left with 8,000. Wow, that's significant. Only your return is almost chopped by half. But I think obviously this is kind of a more extreme example, because I think that investors they probably won't be so unlucky to miss all these 25 base days. But still illustrate the point of trying to time the market, whether you as I as a financial advisor or an investor. And the other thing I think that it's about what you said about folly of market timing. I think it's really, really tricky. Even the best forecasters or like investors in the world, they will say they cannot. They are not able to time the market. Maybe they can see the market right now is a bit low, etc., or some market is quite expensive, but no one can time it perfectly. And I think that's this chart shows it all. Yeah.
Absolutely. And I think there's one saying that I read the other day, and it said, more money has been lost trying to anticipate and protect from corrections than actually in them. So it really is difficult to forecast.
Right. Okay. So is there any point, anything else you would like to share with us?
I think, Kevin, if maybe just to leave everyone with one thing is, the market isn't fun right now, and it's driven by interest rates and inflation and a fear of a slowing economy and a war. There's a lot of market worries, and the market worries change every year. We don't ever have the same worries, but we always have worries. Any year we've seen, but that's really the bad news. The good news is that nobody is bullish, and good things tend to happen when most investors think it won't. And the best days really do come after the worst.
Yeah, that really reminds me of the one of the sayings by Warren Buffett. He said that he's greedy when everyone is fearful, and he's fearful when everyone is greedy. And I think that if we gauge the market at the moment, it seems like there's more and more fear coming into the market. Maybe it's still not the bottom yet. There's still some way to go. But certainly, I think that people are getting more fearful than greedy. I think last year it was a lot of greed in the market, and people are chasing returns, and they think that the stock price has gone up and it can go up even more. The same with cryptocurrency, like when it was $60,000. Some people predict could go into $1 million. So, but now we see the crypto Bitcoins crashing down to 30,000. So yeah, I think the environment certainly right now is turning into people are getting more and more cautious, more and more fearful, and they are saying, let me take my money out of the market. But perhaps this is I think that for the next quarter or two quarters, probably we are going to see the best time to invest. Again, we are not advocating market timing, but I think the lesson here is really about staying invested no matter what. Especially if you are investing for long term, you have a monthly debit order going off to invest for your retirement savings or for your child education. Just stay invested. No matter what happens with the market. And there's also the principle of cost averaging. If the market goes down, then you actually buy more units with the set amount you have. And when the market recovers, actually you are going to enjoy more return from those more units you purchase on that specific amount. So yeah, thanks very much, Roné, for your time. And to all the viewers out there who joined us live and who have said hello to us, I really appreciate. And if you have any questions, continue to leave under the various platforms, whether it's LinkedIn, Facebook page, or whether it's YouTube. And we'd love to respond to your questions and queries. And I just finally, I just like to, again, just a bit of marketing for our company. So this is our company website, www.debris.com. And our WhatsApp number, 076 200 5488. And our email address, if you'd like to be in touch with us to speak about your investment needs or investment queries. But I'd like to wish you well. And Roné, I really thank you for being our partner for us for the last few years, and also today for sharing the insights, for helping me and the investor just to unpack some of these the reasons. And then when we talk about why the actual return right now is rather low, but really we need to continue to be steadfast. And so thank you for the insight and being in this conversation. And I'd like to just wish everyone well and have a good weekend. Until next time. Bye.